Hi, Phil.
Hi
Well,
there, how you doing?
good, thank you. So we can hear you loud and clear. Awesome.
Excellent. Okay, good.
So I think we're good to go. I've just got a little bit of news to cover this morning, so I'll probably get to you about 10 past quarter plus.
Yeah, no problem. And
Perfect.
I've got kind of 15-ish minutes.
Yeah, exactly. Do you like
Perfect.
have a cup of tea? Um, if you just don't mind putting yourself on mute until we need you, that'd be cool. Thank
Yeah,
you.
of course. Right,
Perfect.
brilliant.
Thank you. Talk to you.
Um, Great. Well, I'll speak to you in yeah, in a bit.
Great. Thank you. Right, good morning, everybody. Let's get going. Our guest this week is Phil Waller from JPMorgan Global Core Real Assets. But before we get to him, I've got some news to run through. As it says on the screen there, if you've got questions, please put them into the chat function in YouTube now, please. That's the new way this works. So three little things that I pulled out. One is third point investors, literacy capital, and then what's going on in the battery sector, which is sort of very much unloved. Third point investors first, then. These are all 3-year charts, and you can see that their performance really tailed off over most of 23, and it's making sort of little bit of resurgence now, but that hasn't been anywhere near enough to do anything about the discount, which is still way too wide. So it's about 18% now on a fund with a market cap of about 550 million. So because of all the shenanigans that happened before, we'll talk about that slightly in a minute, there were some discount triggered tender offer in place. So the latest one is for up to 25% of the fund to be redeemed at a 2% discount to the NAV, less costs. And the manager and the shareholders associated with him have already said that they're going to tender their share of stock. So it seems pretty likely to me that the whole thing will be taken up in full. So I think basically what we're saying is the fund's almost guaranteed to shrink by 25%. Redemption notices need to be in by the 8th of May. So, I mean, if you were that way inclined, there's still time to buy some shares and tender them. But obviously, we're only going to get out 25%. So if you could get in at 18 and get out 10, but it's only for a quarter of it. Now, this hedge fund, well, it gives you exposure to hedge funds and invests through a master fund, underlying master fund. So it's got to redeem its share of the master fund, and about 7% of that is in illiquid investments. So once it puts the redemption notice in, it's going to get 93% of that money back in cash and 7% in what they call participation notes, which are sort of a right to the exposure in the illiquids, which obviously they can't do anything about. They have to wait for that portfolio to run off before they get that turned into cash. And because of the way that the tender works, obviously they're not going to distribute those to people who tender, the fund will carry on holding them. So its proportion of what it holds that's in participation notes is going to go up to 9%. And if these tender offers carry on going, then that participation note exposure would rise as a proportion. And obviously that might become a problem by itself. There is another tender offer scheduled for 2027. And it's easier to trigger because the last one was triggered because it was trading at an average more than 10% discount. This one's triggered if it's trading at more than 7.5%. And that measurement period is for the 6 months ended 31st of March 2027. But way before we get there, it's much more likely something else is going to happen. So what they've done is they've appointed 2 new directors who are have been introduced by Dan, connections of his, and so that immediately raises sort of alarm bells about their independence. But the board's been quite careful to say that they think they are independent. These people are sort of activists, entrepreneurial type investors, interesting kind of background. I mentioned this chairman of Plain English Finance here because this is a thing that tried to launch an investment trust some years ago. I don't necessarily think this is what's going on here. I think it's unlikely. But it is interesting that they're going on the board. They are going to form a new committee comprised of those 2 and an existing director, Richard, who was he's a sort of activist director, if you like. He was put on the board of Digital 9 back in end of last year to help get that wind down across the line, and he's just coming off that now. Because that is also in train. He was put onto this board really because asset value investors and people that they kind of corral together were fed up with the discount on the third point and wanted something to happen about it. So he wasn't quite their appointee, but it was sort of, that was how it came about. So the 3 of them together are going to undertake a sort of strategic review. They quite adamant they're not looking for somebody to bid for the company. I think that wouldn't really work anyway, because obviously all you've got is an exposure to the underlying hedge fund. But everything seems to be on the table. And I think it's quite a broad list of things that they've said that they're looking at. And I think it could be something really left field. So I'm quite interested to see what happens here. It might even be that they end up bidding for another fund that's on a big discount. Or just I really don't have any clue as to what might happen. But whatever does happen, shareholders are going to have to say yes or no to it. Literacy Capital has been fantastic investment since it launched. And you can see the NAV marching up there and the share price going with it. And it trades around asset values. It's a small premium now, which is great. And it's been trading sort of a premium for a long, long time. And there was a brief period then when it would have been worth picking some up. Which I didn't do that. There we go. Because of the sort of things it invests in, there is a scenario where it could almost end up having too much cash. And they've just had a situation where an unnamed but large portfolio company has just given them back £20 million because it's refinanced its debt. And it's using the money, Literacy Capital is using the money to pay down its debt with that cash. But because they think similar things might happen in the future and the portfolio is increasingly mature and they might realize more substantial capital profits, because they've done that quite a lot already, they're going to put a B share scheme to shareholders to approve in the AGM. So basically, these things, I mean, you've probably seen them already, but you've got your ordinary shares, you get issued B shares alongside those things, and then the company immediately redeems them. And it's a way of handing back cash through the sort of capital gains mechanism rather than via a dividend. I mean, if you remember, we were talking about Downey Strategic last week, and Downey Strategic wanted to do a B share scheme. It got blocked, and so they're dividending money out instead, and that's a sort of, I think, less tax efficient way of doing it. So if you want to hand cash back, this is a good way of doing it. It would just getting the approval now would mean that any time they wanted to hand back cash, they could just do it without going through a rigmarole of consulting shareholders and having votes and stuff. So I think it's probably a good thing just to say yes to, and then we'll wait and see what happens and how often they use it. But again, it's another example, I think, of just how good this fund is. It's sort of big tick in the corporate governance box for me, rather than just keeping cash on hands or diluting what they do. Lastly, Gore Street Energy Storage. We talked about these battery stuff already quite a bit, but they've just put out an announcement. So just an update I think it's worth looking into. Also, it's worth pointing out that having rallied, do you remember I had a big moan about the way this was being rated and the fact that it was being derated alongside the other battery storage things, and it didn't really make sense. Well, that's all come off again now, and it's now hitting new lows in terms of the share price, and the discounts, really wide too. So 44% discount, credible 12% yield. For full disclosure, I did buy some this week. I paid a slightly higher price than this. It's still carrying on going down, and I just think this is bonkers. I'm going to explain why in a second. The worst rated thing there is obviously Grid, the Gresham House Energy Storage Fund, which is the highest exposed to existing UK battery projects. And I've ranked these by yield, by the way. So Harmony, which is also very, very much unloved, it's down there, and it's down there because it's not really paying a dividend because it hasn't got any earnings, so it can't really do that. And it doesn't look like it's going to get much in the way of earnings this year either. Gore Street is different, and it's different because it's got a lot of international exposure. So they've been doubling down on that. So they've just been investing more money into Ireland. So they've got 2 projects there. The first stage is Portishead thing is going to come online in October. This one's a bit further down the line, and then they've got another pre-construction thing there. these things coming online, they're important because they build in construction phase, and there's obviously quite a lot of risk involved at that stage. Once they come online and are energized, then normally they can write them up in value. So you've always got sort of guaranteed NAV uplifts coming on as these things come on, and you've also got some big projects coming online in California. That's the biggest one. And in Texas. So some at the back end of this year and some into 2025. The interesting thing about this acquisition was that they did it for cash, plus they issued almost 10 million shares at asset value, and the vendor of these things was happy to take those. I think that's just another tick in the box to say that real people in the real world do believe in the asset value. It's just a shame investors don't. And then understand why people are nervous. It's because of this whole business that grids are experiencing, and they're not really getting the revenue through the balancing mechanism in the UK. Because if you remember, there was issues with the National Grid software, and that's been preventing battery storage things from participating. They've sorted that out a bit. But although they are being used more, the revenues that they're getting are not that high, and so basically they're not seeing a material increase in daily revenues from the UK assets that they've got, the GB assets that they've got. And that's clearly really bad news if you're an investor in Gresham House or Harmony, because it's just knocking it down the road again before you're going to see some uplift in the income. There's also bad news because there's another new balancing contract that they thought was going to be quite lucrative, and turns out no, that's not happening, because I didn't even think there was much in the way of coal stuff left, but apparently they're being able to participate in this too. So GB battery storage revenues are depressed and are going to stay that way. I can think for the rest of this year, and you probably won't see much change until early next year, and then it will kind of ramp up from there if it all plays out the way that Gresham House people think. But, and this is the important thing about Wall Street, is that it's got all this overseas stuff already in Germany and Texas, and building this stuff in California. And they are making out like bandits because there's huge volatility in the prices. In Texas, there were some outages of plants anyway, and then they've got a lot of wind in Texas, and so if wind doesn't blow, that obviously means that prices for electricity spike up, and there isn't really a proper interconnector between the Texas grid and other grids in other parts of the US, so they can't import electricity to offset that. So they got this big spike to $1,000 a megawatt on the 4th of March, and the battery storage was sending power into the grid at this sort of prices. And they're getting similar things, huge volatility in the amount of electricity being generated in Ireland because of the storms that are going through. So yeah, I just think that this is all set quite fair. There is a holder of GSF there who's put a question in the chat, so we just look at that now. So he's saying, how much cash was issued long shares and shares? I think I do know the answer to that, but I haven't got it in my head, and so I will dig it out for you. Yeah, don't worry about it. So basically, that they have not done any kind of dodgy deal here. This is a sort of sensible thing, and the fact that issuing the shares at asset value means there is no dilution for you as a shareholder. Good. So that's enough from me. Now let's talk to Phil. Good morning.
Morning. How you doing?
All right, thank you. Thank you very much for doing this. We're going to learn all about JPMorgan Global Core Real Assets. So, as usual on these occasions, can you sort of start off by just explaining a bit about the fund, please, and then we'll get to some questions later on.
Perfect. Thanks, James, and obviously thanks everyone for joining this morning. So, Yeah, kick off in terms of what Jara is. Maybe if you just go on to the first kind of summary slide. Um, Jara, we launched Jara in 2019, and really what we've looked to launch and build is really a kind of foundational or cornerstone allocation for investors within the real asset market. And we get that foundational quality, I would say, in two key ways. Firstly, it's through our diversification. So as you can see on the right-hand side here, we are not a targeted or niche real asset strategy only focused on one particular sector or part of the market. We are broadly diversified across really the kind of key three pillars of real assets. So infrastructure, with sectors like utilities, energy, fixed transport like airports and seaports, transportation, so that's both floating, flying, but also increasingly trains as well. And then, as you can see at the bottom, real estate and the traditional kind of core four sectors there. So well diversified across the real asset market. We are also, I think, quite uniquely globally diversified. And I'll talk a bit more about that later. But we are, in many ways, and a lot of our investors do use us as a global complement to their often UK-centric real asset allocations. And then the other key thing that gives us our kind of cornerstone quality is we are focused, as it really says in the title, we are focused on kind of what we call core assets. And like any investment asset class, there is a spectrum of real assets. Some at the higher end risk of the spectrum, some at the lower risk end of the spectrum. We are at that lower risk end. We are core assets for us are higher quality, more income generating assets. And so really the real assets we are investing in are more stabilized, income orientated, and that ultimately feeds into that cornerstone quality that we're looking to provide investors. So we bring all that together and target a 7 to 9% total return over market cycle, of which roughly half to two-thirds is coming from a quarterly income stream, current dividend yield in the mid to high fives at the moment. Interestingly, I think, and importantly, how do we build a portfolio like this that's so well diversified across different markets, different geographies? Well, as you can just see in that bottom left bullet point, is we are using the existing JPMorgan alternatives platform to build this. And that means when I talk about a diversified portfolio, I really mean it. Over 20 different sectors on a look-through basis, over 1,400 private assets, and over 30 different countries represented in this portfolio. And it's because we're utilizing that existing platform to do that. So for me, just go on to the next slide to show this platform. At a high level, at JPMorgan, we are a big alternatives player. We have over 212 billion, as we say on the top right, in assets under management across alternatives. And alternatives for us is quite a broad church. It's really anything that sits outside traditional public equities and public fixed income. But obviously, what's important for Jara is the real asset side of things, which you can see highlighted in the pie chart in the middle. So real estate, other real assets like infrastructure and transportation, but also liquid real assets as well, is a significant part of what we do. It's over half of the platform. And we've been doing that for over 60 years. We've got a significant track record as well. And it's the existing private vehicles, existing private strategies that we are investing in. And I think importantly, a lot of this platform, a lot of this business has historically only been open to the more traditional institutional investors. So pension funds, insurance companies, and the like. And really what we have with Jara is a way for private investors to access this institutional quality platform through obviously the investment trust structure. My team, the team that manages it, is on the left-hand side, the alternative solutions team. We've been around for over 12 years, and our job is to build diversified portfolios exactly like we have with Jara, using this platform. And ultimately looking to build portfolios where the sum of the parts are greater than the parts individually. And actually, that's what we think we've achieved with this portfolio. So maybe if we go on to the next slide, we can just show how we bring this together in terms of an allocation. So on the left-hand side, we've got our strategic asset allocation. So, the bands that we operate within. in terms of how much is in real estate, infra and transport, and then other parts of the liquid and real asset market. And on the right hand side, you can see where we're currently positioned. So, couple of broad comments here. Firstly, you can see that we have this good mix really across the real asset spectrum, both public and private. And on the right hand side, you can see where we're currently positioned. So, quickly running around the pie chart, we have 35% in global real estate. Now, importantly, if you look at them, two little bullet points beneath the kind of big title, you can see that we're focused on US core real estate and Asia Pacific core real estate. So we're not focused and we're not invested in UK and Europe, and that's very, very intentional. Really, since IPO, going back to us being a global complement for investors. We know that a lot of investors already have a significant exposure, particularly to the UK within real estate. What they don't have access to, or what they find it more difficult to access, is Japan residential or logistics in Singapore or US single family housing. And that's exactly what we look to provide exposure to within our real estate portfolio. We then have 20% each in infra and transport. And as you can see by the arrows, that's an area that's been increasing throughout 2023 and continues to increase in 2024, and talk about our views and why that's happening later. And then we have currently 16% in liquid real assets and 7% in real asset debt, to bring together that kind of very, very well diversified, high quality portfolio. If we move on to the next slide, we can see what this means from a geographic, and I know I've already banged on about it being a global portfolio, maybe one too many times, but just to make the point again, as you can see in the middle here, it is, when I say global, we really mean it. 55% North America, 18% Europe, of which 2% is in the UK, and just under 30% in the developed markets, primarily of Asia Pacific. And why is this kind of global split important? Why do I keep going on about it? I guess, I think importantly for us, when it comes to real assets, one of the big drivers of risk and return is really the local market in which these assets operate. We just talked about battery storage and some of the various dynamics that go on in each market there. The same is true across the broader array of real assets. And so it's something which really needs diversifying. Diversifying that local exposure, or that country by country exposure, should hopefully allow for better outcomes over time. And JARA is, I think, a great option for investors who want to have that global diversification. We talked about the look through private assets, over 1,400 private assets, as you can see on the top left, split between infrastructure, transport, and real estate. Again, we get that diversification because we are leveraging off that portfolio, the underlying platform. And again, because we're so well diversified, we help remove some of the idiosyncratic asset risk and counterparty risk that can often be prevalent in the real asset space. Final point on this slide, with a global portfolio does come global currency. We are therefore got a good mix there with a bit of a bias towards dollar. We have a partial hedge within the portfolio to bring ourselves to 20% sterling. But nevertheless, it's something to be aware of, that there is that kind of look-through currency exposure that is absolutely present in the portfolio because of where our assets are based. So if we move on to the next slide, maybe to do a little bit of a focus on a couple of the key areas of the portfolio, just because of trying to do this in 15 minutes, I've decided to focus on infra and transport and real estate. So not talking about the listed or the debt side, but happy to answer questions at the end. So here we just kind of summarize where we are within infrastructure and transportation. As you can see on the left-hand side, starting with infrastructure, which is at the top, you can see we are primarily focused on two key sectors, so utilities and renewable energy. And we're focused there, one, because these are the sectors for us that in the infrastructure space can give us the most predictable, high-quality return profile we're looking for. If you look at that graph on the top right-hand side, this is utility spending going back to the late 1970s. And you can see that the cost of utilities as a percentage of household income has gone down. But importantly, from the grey bars, you can see that actually recessions don't really impact how much people are spending on electricity, on water. People want to continue paying their bills. And so as a stable provider of return, we see utilities as a really, really good asset class. Importantly as well, both for utilities and renewable energy, There's a lot of opportunity to invest, particularly in relation to the energy transition, renewable energy for obvious reasons, but also utilities do need a significant amount of upgrading to make them resilient to things like global warming, but also evolving them to fit the new grid. And so a lot of opportunities that we've seen both in the last few years, but also going forward for us to invest in these sectors. Onto transport. And again, you can see that there is a bit of a focus for our portfolio in two key sectors. And actually, these are the more floating sectors. So we are more of a float, whilst in transport, we can allocate to aviation and shipping, but also railcar. We are more on the shipping side in maritime and energy logistics. And what we do in transport is we're ultimately owning these assets, these shipping assets, these aircraft, and we're leasing them out to counterparties for typically 5+ years. And so looking to generate a predictable income stream from that return. I think a key thing that we've seen in the transport market, particularly in the last 6 months, but actually going back further, is quite a lot of disruption. A lot of that being more geopolitically driven. So obviously a lot of news around the Red Sea at the moment and the impact there. If you go back to the kind of the onset of the Russia-Ukraine conflict and the impact that had on energy supply within Europe, and then even going back further to COVID and all of the queuing outside of ports we saw. A lot of these disruptions typically have one kind of key trend, and that is ultimately they constrain supply. If like going on the Red Sea now, if ships are going around the Cape of Good Hope and it adds 15 days to a journey, that's an artificial constraint on supply. And what you are seeing, as you see on the bottom right hand side, is that's causing an uptick in lease rates. And as an owner of an asset looking to lease these assets out, that has been positive. And we do see that kind of ongoing disruption as being something that is going to continue in the transport market. So an area that we've continued to like. If we can just shift on to the next slide on real estate. Again, obviously a market that's been a big focus and a lot in the news for investors over the last 12 to 18 months. Primarily because we've seen a pretty strong repricing across a number of real estate markets. Now, I think importantly for us, a lot of that repricing has been driven by interest rates, not necessarily the fundamentals of the assets. So occupancy, rental growth, on the most part, has been pretty strong. With the exception probably of office and certain markets within office, which I'm happy to talk about later. But generally fundamentals have been good. And so now we are likely at or close to the end of the kind of rate hiking cycle across most economies. We do see that as being a kind of key valve that could release some repricing going forward. And if you look at that graph on the right-hand side, this is kind of forward-looking or unlevered IRRs, so the rate of return expected from transactions. You can see that repricing has meant that is now at the highest level since the financial crisis. So actually, pricing on the most part, given fundamentals have been stable, look relatively attractive. But with the key catalyst likely being the unwinding of interest rates in key economies at some point later this year, which I know is still a moving target somewhat. I think importantly as well, we do have that geographic diversification. You can see that on the bottom left-hand side, across US, but also different markets in Asia. And there has been a significant geographical difference as this repricing has occurred. So whilst UK, Europe, and the US have seen some pretty heavy repricing, actually, the Asia market's been pretty stable. And that's because of different interest rate environments, different growth rates there. And so having that sector mix, or that country mix, I should say, has been a real positive. So that's kind of a kind of quick run through on that portfolio. Maybe just onto the next slide, please. To bring this together, we've got this really well diversified global portfolio, and we do see several key themes, really playing out. And not to necessarily go through each of these in detail, but these are kind of the key themes we have in the portfolio at the moment. But also themes that we see persisting going forward. So one, for example, e-commerce acceleration. There's still a very significant opportunity there, particularly in certain markets like Asia. And what we are seeing is the ability to invest in it, both in terms of logistic assets, but also container ships where we have exposure. Platform acquisition is also a big part of what we do. To explain what that is, ultimately we see the opportunity to incrementally invest behind the existing assets we have, as opposed to constantly going out and buying new ones. So, for example, if we have a wind farm platform, we see opportunities to make smaller bolt-on acquisitions to them assets, and therefore grow them, benefit from the synergies of scale. And that's been a big part of what we've been doing, particularly as rates have risen. The energy transition, both in renewables but other parts of the market, as I've already touched on, is definitely going to be a continuing theme. Emerging core sectors. So, it's a smaller allocation because it's emerging. But this is where, as things like AI, data centers come online, the types of assets that we'll invest in are evolving. We are a core investor, so we are going to probably evolve slightly more slower than others as we want to see stability of regulation and technology. But nevertheless, it is creeping into the portfolio and absolutely an area we see ourselves investing going forward. And finally, we are a long-term investor, and so having a long-term outlook in how we manage the investments from an environmental perspective, but also a social perspective, is really, really important, and is really, all the assets we have, very much keep that lens in mind. So onto performance. It's on the next slide, and similar with other kind of real asset trusts, I think at the moment we have seen a kind of tale of two different tales here. Firstly, on the NAV side, which is in the top left, and with rising interest rate, as we talked about with real estate, there has been a difficult period for a lot of real assets. Some markets down 20, 25%. And what you can just see with Jara's portfolio, if you look at the last line on that top table over 1 year, local currency returns, so stripping out the impact of currency, we've had a pretty much flat total return. And so actually we've held up pretty well in what's been quite a difficult market from an NAV perspective. And that's really the real estate side having some impact to NAVs, but being offset by the positive performance we've seen in infrastructure and transport. And that's really what Jara is designed to do, is to be a bit more stable than any one particular sector focus, and really give greater stability over time because of that. And so we've seen a stable return. If you look at slightly longer term numbers, so over 3 years or since we've been fully invested, you can see we're actually more in line with our kind of target return, just under from a GBP perspective in terms of the 7 to 9%. And you can see that the income that we're targeting has broadly been in that 4 to 6 range that we've been aiming for. There is a different story though with share price, and similar to other income or alternative or real asset vehicles in the market, we have seen some pretty significant discount volatility, and that widen out and impact share price returns. But hopefully with that stability of NAV and the fact that we are hopefully close to interest rates across key economies being cut, and therefore providing, I think, further tailwind to the real estate side, but also the infrastructure and transport side that's been pretty strong performing. Hopefully we're in a good position to see that or have a catalyst for that to re-rate as that starts to come through. I think another key point that's, rates have been one, I think, a factor for the derating across the real asset market. The other is, I think, concerns around valuation. And maybe if we just go on to the next slide, we have looked to address this, and there's a concern from investors around, okay, what are private market valuations looking like, and are they actually the same as the appraisal values that these vehicles use as part of their NAV? And so what we've done, and this is really driven by the board, is we've actually looked at going back now 18 months, what has been the sale value of the underlying portfolios versus their appraisal value across all the asset classes we invest across. And so as you can see, we have about 15 different transactions going back to Q22, and again across really all of the key markets we're invested on. And as you can see, there is some variability, but on average, the assets that have been sold within the underlying portfolios have been sold at just above plus 1% compared to the holding value. And so I think that's important that actually, we do have a robust quarterly valuation process. It is significantly independent, using the usual third parties. And that's, really, I think, played out in the consistency of the valuation versus sale price on an average basis. And hopefully gives investors some comfort that, again, hopefully a catalyst as things hopefully re-rate, that the valuations is a fair and true reflection of what can actually be achieved in the market. I think final slide for me on the next slide, just before we open up and see if there's any questions. Hopefully, I've touched on a lot of these as I've gone through the portfolio, but obviously that discount has been there for throughout the kind of second half, in particular of 2023. We have obviously taken a number of steps alongside the board to look to narrow that and position Jara as best as possible going forward. So, for example, we have seen an increase in the quarterly dividend by 5% year on year. We continue to reduce real estate exposure. That has dropped now by pretty much 5% since we started that. We do see actually real estate pricing now starting to hold up, but nevertheless, the benefits, the higher income, the stability, and also the benefits they'll see from the energy transition in infrastructure and transport mean that is an area that we are looking to increase. Look to dampen some of the currency fluctuations that have caused a bit additional volatility in the NAV as well, as we talked about with the partial hedge. And the board have been proactive from a buyback perspective as well. We purchased about 4% so far, and that's been an ongoing program. So very much focused on how and creating the catalyst for that discount to narrow in the not too distant future. So maybe final slide, just as the summary slide, one we can leave up as maybe questions come in. But in summary, Jara, we are a core real asset portfolio that can really act for investors as a foundation allocation within their portfolios, given our focus and our diversification across core assets. We have a very, very significant level of exposure, both across private assets of over 1,400, but also on a global basis. So we are quite unique in the market from that perspective. And we, as I hopefully kind of touched on, we see a lot of opportunities, particularly across infrastructure and transport, which are key areas we like, and we are increasing within the portfolio. And I'll pause there.
Great, thank you very much, Phil. So whistle-stop tour around the world. Couple of questions on the dividend first, I think. So firstly, is the dividend covered by earnings now? And how important is it that whether it is covered or not?
So the dividend hasn't always been covered, and there has been a bit of variability, particularly in some of the sleeves and real estate, particularly last year, slightly lower income. But with the kind of additional share capital from share issuances, the board have used their additional kind of flexibility to kind of keep it and maintain it. And I think as we in particular increase that allocation to infrastructure and transport, that will allow it to be covered more fully going forward, and that is a focus for the board. So yeah, I think in particular will come from the full coverage will come from increased allocations to infrastructure and transport, where the yield is materially higher than the real estate side, and that is one key aspect of our motivation to increasing it, as long as some of the other key trends we see, such as these markets are slightly more linked to inflation. So to the extent we have inflation volatility going forward, they should benefit, as well as they're kind of slightly closer linked to key trends across the energy transition. And so yeah, the board are focused on making sure that is and remains covered. And that's why one of the reasons that the asset allocation is evolving slightly.
Fair enough, that makes sense. In your mind, though, would it make more sense to grow the dividend or use the money that you would have used to grow the dividend to buy back more stock?
It's a difficult one, because and ultimately a question for the board. I think the board do have the firepower to continue the buyback program because of that listed allocation. Mm-hmm. So we have 16%, in more listed real assets. So we're not a real asset portfolio that is, for example, fully invested in private assets with no liquidity and has an RCF on top to do buybacks. We're actually more prudently structured than that. And so I don't think you would necessarily need to hold cash flow back in order to continue the buyback program. And ultimately, what that liquid allocation does, importantly, is it gives you time. So if you do have some operational requirements in terms of cash flow to use a listed side, and then rebalance more fully over time out of the privates, which obviously takes a bit longer. And so I think the board actually have flexibility not to do both.
Okay, that makes sense. How liquid or illiquid is the underlying portfolio generally? I mean, I suppose it varies by asset, but is there like an active secondary market for a lot of this stuff?
Yeah, so we are. So yeah, it's a good question. We are primarily focused in the private side of investing in open-ended vehicles. And so that means that typically on a quarterly basis, we have the ability to either subscribe further or make redemptions. And you typically submit, 30 days before quarter end, I'm averaging here, and then you get your capital back on a best efforts basis, 60 to 90 days thereafter. There are typically lockups. This is why these underlying vehicles themselves are quite institutional. We are generally through the lockups now, as we've been going for 4 years. And so we do have the ability to get some capital out of the portfolio. That's been one way that we've actually been looking to increase the infrastructure and transport. We've actually been redeeming over time from the real estate equity side of things. And as money has come back, we have increased, in particular, so far, we've increased our allocation to the infrastructure side of things. But yeah, it is naturally less liquid than public markets. But given the nature of how we're allocating to, there is the ability to evolve over time. You can't wake up every day and try to underweight private real estate versus private infrastructure. What you can do is evolve it over time to kind of meet the needs of the company and also the market environment that we think we're entering.
Fair enough, thank you. How sensitive is this portfolio to changes in interest rates? And does it matter that we've got this sort of delay in rate cuts?
Yeah, so I think it's one of the natural kind of points of jar. We have this diversification across asset classes, and that means that different asset classes will behave quite differently. And that's ultimately, we feel, a benefit over time to hopefully smooth out some of the volatility that any one asset class can see. So, where we have seen the rate sensitivity is in real estate equity, which is about 35% of the portfolio. And yes, I think that will benefit, particularly I think within the US market, some of the price declines have probably been, in particular, not pricing in a soft landing, but pricing in more of a recession scenario. So to the extent we do start to see that soft landing firming up, as well as some rate cuts towards the end of the year, that would benefit the real estate side. Infrastructure and transportation have been less sensitive. And there are various reasons for that. One is, I think in particular, is the debt profile is longer. And so you haven't seen the same drag that kind of feeds more quickly into the real estate side. And then there's also been some parts of the market that have been positively impacted. So actually real estate debt, one of the reasons we actually added that allocation in 2022 was it's primarily floating rate. And so that's actually benefited as rates have gone up. And so, when we first allocated to it, I think we're getting probably a 5.5–6% net yield. We're now in the kind of more 8 region. And so that has benefited, and that was part of the portfolio construction why we added it, as we saw that was likely, that the rising rate environment was likely going to be a drag on real estate. Now, one of the points to make is we are not necessarily focused on one particular market of rates either. So we're not linked necessarily to the UK rates, and actually, only 2% there. The US is probably the main focus, but again, we do have things like Japanese residential. We have markets in exposure to Australia, Singapore, which are all on their own kind of interest rate hiking cycles, and so that again, that diversification plays into the portfolio and hopefully smooths things out as well.
Okay, thank you. There's a question here about digital infrastructure. So, I mean, you said data centers. I saw that was in the kind of emerging core bit. What's your view on digital infrastructure as an asset class, and would you like to have more of it?
Yeah, so actually the data centers we've done, and this can be a bit of a grey line, I guess, across the industry. We've actually mainly done that in the real estate bucket, as it were, so far. And we, within infrastructure, have not really entered into the digital infrastructure side of things. And I think very simply for us is, we are looking across the portfolio and obviously within infrastructure itself, looking for the core side of the return profile. So we're looking for assets that can produce a contracted, regulated income stream that's highly predictable and highly forecast. In order to get that, you need stable regulatory systems, stable technology, high quality counterparties, and typically, as industries mature, the length of the contract gets longer as well. And obviously, whilst it's a market that we follow and have looked into detail, it really hasn't ticked all them boxes from a core perspective yet. Because there is still the ability for things to evolve. There is still regulatory change that will probably happen, and so whilst we can enter it at some point in the future, it's not been an area that we've looked to because it hasn't really fitted that core return profile, that core aspect that we're looking for. And also, Canada, there's probably slightly high pricing there at the moment as well, given the focus on it. Compared to kind of where we've been deploying in the more kind of smaller platform acquisitions I mentioned, the bolt-on acquisitions in renewables and utilities that have been, very much more of our stomping ground over the last 12 to 18 months.
You talked about the returns available on private, real estate debt just now.
Yep.
What sort of returns are you getting on your investments generally?
In real estate debt?
Well, no, across the piece, across the whole fund.
So in terms of where we're expecting,
if you're making new investment tomorrow, what sort of
yeah. So right now probably I think we had an IRR chart in for example for the real estate side. You're looking at somewhere between, on a core perspective, 8 to 9% from a real estate perspective, and you're probably looking at around 10% for transport. That is probably the asset class that's a bit more core plus, a little bit more leverage. You are actually generating a gross income from a lot of transport assets of close to 12%, and so that's where you get to that kind of 10% number. And then on the infrastructure side, probably a little bit lower, so probably kind of the 7 to 8% number. For infrastructure, particularly in the core space. Before the repricing in real estate, that was probably the slightly lower end of things. So probably it was in the kind of 6%, but now that's repriced. You're closer to kind of low double digits there. So that's the way it looks. I mean, obviously, the drivers of returns not necessarily about it's not all about where you're putting the next dollar of capital. So obviously the existing assets you have. But yeah, that's where we're currently kind of seeing the general underwriting, I think.
Yeah. I mean, but I talking about the sort of return target is over a cycle, and we've had a part of the cycle where returns have been quite low because the interest rates have been quite low. But now we've got a higher return environment, and that will all average out. Is that fair enough?
Yeah, that is fair. I think we're in obviously a higher rate environment. There are some negatives for real assets with that, where obviously these are typically levered assets. So we don't have any leverage at the company level, so we are unlevered. So I think some of the issues around leverage at the company level that you've seen in the investment company market isn't relevant to Jara, but there is a leverage at the asset level, and that can be a bit of a drag. But with higher rates, actually, you should be earning the underlying rental yield growth, the underlying income growth should offset that over time, and therefore help you generate a higher return. As I say, we are seeing that in particular in the transport market, and now with the repricing in real estate, you get that average over time for sure.
Yeah, great. Okay. Just sort of digging slightly into the emerging core stuff. What's in the emerging core things that you think you might actually put some money behind?
Yeah, sure. So the emerging core, so if you think about, I'll maybe go across each of the kind of key pillars separately. So real estate first, I think where we've kind of dipped our toe so far from an emerging core perspective, so new types of sectors, is really actually variations of the big ones. So if you think about, for example, office, actually an area that we have still added in office over the last 12 months or so has been more like biotech, healthcare, specialized office in obviously industries that are growing and do need office space. Another big focus for us is actually residential, and a new sector of residential in particular, more single family housing. Now, if you think about institutional investing, when people talk about residential, they often mean big apartment buildings, 30 floors, and you invest in one, and you obviously you rent each one out. Technology, but also demand. The generation rent, the millennial generation is now, I think, on average over 30. You've got families within that cohort now. So actually, there's a demand for single family rentals as well. So actually, being able to buy up and rent out single family housing is a new sector that we've entered into. From an infrastructure perspective, I say we're probably moving a little bit more slowly, but we have done on the margin things like battery storage, not in the UK, more globally, and we have done biomass as well from an energy development perspective, and they're more smaller allocations that we're looking to understand the technology and then grow over time. And then finally, an area on the transportation side, maybe less true emerging, but one area that we have increased exposure significantly is liquid natural gas carriers. And that was was an established market, but one that's clearly erupted in terms of demand over the last few years. We actually decided to enter that back in 2019 with a bunch, and we actually put on a number of new build contracts, and so got assets delivered in 2022, 2023, just as the demand was spiking. And so that's been an area in transport, as well as we do like things like wind farm maintenance vessels. So as offshore wind farms have become more prevalent, they've often got further and further out to sea, so you need more specialized vessels. And again, that's a new area that we've been investing in. So often these new sectors are smaller allocations to start with, and then they grow over time. But they're the kind of opportunities that we're either invested in or tracking, I think, at the moment.
Oh, just the discount. Obviously, it's a massive opportunity for investors if the discount can narrow. What do you think the core ways of that, the key ways of that might happen will be? And also, do you think it's fair to look at the discount on this and compare it to the discount on infrastructure funds, for example?
Yeah, so maybe if I take that second one first. So, what we have seen, and it varies from time to time depending on certain market conditions. Actually, we are a mix of real estate and infra, and broadly we have, on the most part, traded somewhere between the two. And clearly there is a slightly tighter rating, I'd say, on average. There's obviously different companies behaving differently in the infrastructure space, and so to the extent we can trade more in line with that, clearly that's a positive for everyone. But yeah, generally I would expect us to trade either in between the two, or maybe slightly close to infrastructure, given we are focused on that more income generating, stabilized part of the market. So that's kind of that side of things. I think in terms of the narrowing of the discount, I think clearly there's a broader dislocation in the market across alternative income strategies, and there's probably three key drivers of that I see. One is where there's been idiosyncratic, particular, certain vehicles having particular issues, whether it's around leverage or pricing, etc. But then there's more, I'd say, broader kind of terms, which is one, the views around valuations, and two, the interest rate environment, meaning some investors are going, well, how do I price this versus other income options? And ultimately, I think we went through that slide on valuations where we feel that a very, very independent and robust valuation process that has played out to be, I think, a really true reflection of NAV over the last 12 to 18 months. But ultimately, I think you are going to need to see some easing of interest rates before that repricing across the market starts to occur. Obviously, within that, we are looking to do what we can, and so as you say, infrastructure, certain transport names trade a bit more tightly, and we've been leaning into that. both in terms of a portfolio management conviction, income, as we discussed with the board, and also we see the benefit from that in terms of market demand, and then also increasing the income and share buybacks will incrementally help. But I think it's as ever with these things, it's a package as opposed to a golden bullet that will solve everything.
Fair enough. Do you think is the size of the fund a problem, especially if you do more by share buybacks, or doesn't it really matter from the way that you're running the portfolio?
Yeah. So
and also,
yeah.
Would you like to make it bigger? Well, I obviously like to make it bigger, but do you think it's feasible to make it bigger?
So I think one of the really nice things about JARA, so we're investing in these existing private vehicles, and actually whether JARA is 100 million or 500 million, our portfolio can actually have a very, very similar diversification. And so our ability to, we've already got significant diversification over 1,400 private assets, and because we've got these existing portfolios already, we can get that diversification to some extent, irrespective of size. That's obviously, I think, a positive. The other positive there is actually these underlying portfolios are always evolving because we're not the only investor. We've got other institutional investors alongside us. And so actually, even if JARA hasn't got another dollar of capital to invest right now, actually, we may still be buying assets in the underlying portfolios, of which JARA then becomes a small owner of and have exposure to. And so we're able to evolve the portfolio on a look-through basis, irrespective as well, which I think is really, really important. It means we're not just stuck with the same assets. We can absolutely move into areas that we have conviction. Do we see an opportunity to grow it? Yes, absolutely. I think hopefully as this period of dislocation subsides, then we have a strong pipeline. We do see continued opportunities for JARA to invest both in the existing strategies, but potentially new ones that come along as well. And obviously, as it grows, that increases things like liquidity, reduces costs, all things that benefit shareholders as well. And so I think there's absolutely a strategic focus for us to do that as and when the time allows us.
Great. Well, good luck with all of that. I do hope it does grow. I just hope you're doing something different, which is always cool, I think. So thank you very much for your time this morning, and we'll get you on again in a year or so.
No, brilliant. Thank you.
Thank you, Phil. We'll be back next week talking to Ecofin, which is slightly similar. Some sort of overlaps a little bit, but more listed stuff. So Jean-Yves will be there on the 19th, and then we've got a full lineup as usual. We are still nailing down the 3rd of May one, but I think we are almost there. So in the meantime, have a good weekend, have a good week, and we will see you next Friday. Thank you.